Now, how they make money is they buy smaller businesses and then have de novo organic growth. They would buy $1 million EBITDA landscaping business, let's say in an adjacent state, Oklahoma, and they might pay, let's just use round numbers here, 6 times for that business. So they're going to pay $6 million for that business. Now remember, they're worth 15 times. So just by that business being part of a larger business, that $1 million EBITDA business is suddenly worth $15 million on paper to them. So now that they're a $21 million EBITDA platform, they're still worth 15 times, and they're now worth $315 million, even though they only paid you $6 million. I know this sounds a little wonky, but this is called EBITDA arbitrage. This is how private equity aggregators make money on paper. Who's going to buy my business? That's the top question we're asked on every single call with a prospective client. Who's going to buy my business? And a lot of essential service business owners are surprised when we talk to them about what's happening with private equity consolidation and all of these national platforms that are coming together and scooping up local mom and pop essential service businesses just like yours. Hey everyone, I'm Oliver Bogner, managing partner of the Advisory Investment Bank. We're a lower middle market investment bank focused exclusively on all things essential services: HVAC, plumbing, pest, landscaping, fire safety, irrigation, CPA firms, elevator repair and maintenance, restoration. If it's an essential service, we cover it and we know exactly who to sell it to and how to get you top dollar for your business. I myself am a 2 times Forbes 30 Under 30 honoree, 2 times Inc. 5000 CEO, and I've built and sold 5 different companies and sold them myself to private equity firms, competitors, strategics. I know exactly what it takes to be an operator, to be in your shoes and sell your baby, sell your life's work. I've done it a couple times over. I started the Advisory Investment Bank because I genuinely believe that Main Street business owners deserve Wall Street level outcomes. Wall Street continues to get smarter and smarter as they're continuing to consolidate essential service businesses, and they need to fight fire with fire. That's why we exist. We truly exist to defend Main Street business owners against Wall Street. So if you've ever wondered who's going to actually buy my house, buy my business, right? This isn't a house. Who's going to actually buy my business? This video is for you. Because the reality is not all buyers are created equal, and understanding who's out there, what they value, can make a huge difference between an average deal and a life-changing one. We're going to break it down right now. When you go to sell your business, there's generally 3 categories of buyers. And again, we've done other videos on this. Whether you're working with us or another advisor, these are the 3 types of buyers that you get access to when you're working with an expert in your industry, typically an investment bank versus a business broker versus going directly with a buyer. There are 3 different types of buyers. If you're working with a business broker, typically they're only going to talk to search funds. They're going to talk to SBA buyers. When you work with an investment banker like us, we really bring 3 types of buyers to the table. We bring, number 1, strategic buyers. These are industry players, competitors, adjacent companies looking to expand. So number 1 buyer pool, strategic buyers. Number 2, private equity firms. We'll talk about how private equity firms look at the lower middle market, how they look at essential service businesses, but these are financial buyers backed by institutional capital. And then number 3, search funds, independent sponsors. Smaller entrepreneurial investors acquiring one business at a time and typically relying on SBA financing to help fund their acquisition. So we're going to break these all down. Strategic buyers. They're already in your space. They know your industry. They speak your language, and they're looking for synergy. They buy for growth, geography, or a new capability. If you run an HVAC business, this might be a regional consolidator looking to expand into your market. They'll typically pay for cross-selling opportunities, customer overlap, operational efficiencies. The pro is they can move quickly and see strategic value. The con is they also are competitors, so confidentiality and deal structure really, really matter. Now, in a lot of industries, there aren't true non-private equity backed strategics. Most of the strategics are private equity backed. But if you look at the pest industry or the landscaping industry, you absolutely do have publicly traded strategics, privately held strategics that are not private equity owned and have different incentives, right? They're not necessarily looking to create paper value, they're looking to create real value, real efficiencies, real synergy. So, strategic buyers. Number two, private equity firms. Private equity firms are financial buyers. There are 4,000 of them in the US. They have $7 trillion of dry powder under management. They raise large funds of money from investors and are required to invest that capital. About 1,000 of them have fallen in love with essential service businesses. Here's why they like essential service businesses: predictable recurring revenue, strong margin, and a highly fragmented market with room to consolidate and have efficiency. PE firms typically fall into two buckets. Either one, they're looking at your business as a new platform, so they're building a flagship company in your industry. Or two, they're an add-on buyer. So they already own a platform and want to tuck your business into that platform, and we'll talk about how they make money via EBITDA arbitrage. Typically, to be considered a platform, we need to see at least $3 to $5 million of EBITDA. That's really the only way we're going to get a lower middle market private equity firm to lean in and look at your business as a new platform. Add-on businesses sell at all shapes and sizes. Typically, the minimum for an add-on is $500,000 of EBITDA. And again, they can swallow very large businesses as well. They can go up to 3, 4, 5 more of EBITDA. So platform buyers, add-on buyers, they're both owned by private equity. Private equity firms who like essential services, there's roughly 1,000 of them that really like essential services. They're typically our candidate to be a platform buyer. So let's say we have a $5 million EBITDA landscaping business. There's 1,000 buyers that like essential services. Only 90 of them are currently invested in landscaping. So there's 910 that are not invested in landscaping, but might want to go into landscaping. That's our buyer pool. If you're a smaller business, you don't have that second layer of management team really built out. You don't have all those systems and processes, but you have great customer relationships, great history, great brand in your community. You're a perfect candidate as an add-on for an existing platform. This is the most common deal that we deal with. This is the most common type of client that we have, where we're selling their business to one of the private equity-backed consolidators. These are quote-unquote strategics, but they are private equity-owned strategics, private equity-owned aggregators of a specific industry. They already own a platform and they want to tuck in complementary businesses. They make money on what's called EBITDA arbitrage. So buying you at one multiple, rolling you into a larger platform, and then selling the entire group at a higher multiple. This is how they make money, whether you're a new platform or you're an add-on. Now, I'm going to double click on this because it's really, really important to understand how they make money and why they buy essential services with this strategy. So if you are a $20 million EBITDA landscaping business, let's say it's $100 million top line, a $20 million EBITDA landscaping business in, let's say, Texas, that business is worth, on a bad day, probably somewhere in the neighborhood of 10 to 15 times. So let's just use 15 times as an example. So that business is worth, on the open market, $300 million. Now, if it's a $20 million EBITDA landscaping business, more than likely it's owned by a lower middle market private equity firm. We would imagine that they typically have between $500 million to $4 to $5 billion of assets under management. That's a lower middle market private equity firm. Sounds like a lot of money, but there's much, much bigger private equity firms that have 30, 40, $50 billion of assets under management. Lower middle market private equity firm typically has $500 million to $4 to $5 billion of assets under management. Following my talk track here, right? $20 million essential service landscaping business in Texas, valued at $300 million. Now, how they make money is they buy smaller businesses and then have de novo organic growth. They would buy $1 million EBITDA landscaping business, let's say in an adjacent state, Oklahoma, and they might pay, let's just use round numbers here, 6 times for that business. So they're going to pay $6 million for that business. Now remember, they're worth 15 times. So just by that business being part of a larger business, that $1 million EBITDA business is suddenly worth $15 million on paper to them. So now that they're a $21 million EBITDA platform, they're still worth 15 times, and they're now worth $315 million, even though they only paid you $6 million. I know this sounds a little wonky, but this is called EBITDA arbitrage. This is how private equity aggregators make money on paper. Now, the private equity firms are incentivized to deploy capital. They get paid based on assets under management, which means a $300 million business, they get paid 2% of that annually plus 20% of the upside. So all private equity firms make money off this concept called 2 over 20. So $300 million, they get paid $6 million a year for managing that investment. Now, let's say they just acquired you. They now get paid $6.3 million a year for managing that asset. They are incentivized to continue to grow AUM, continue to grow assets under management. The pro, deep pockets, really smart operators, professional management teams. The cons, sometimes complex deal structures, more diligence, more negotiations. This is typically who your buyer is going to be. It's why it's really important to understand their wants, needs, how they value businesses, and how to actually get to the right decision makers inside these complex organizations. So my third pool of buyer, which we do not advise founders to necessarily work with. These are really tricky, high probability of failure rate once we actually get under LOI. Very, very low probability of close. These are search funds and independent sponsors. These are smaller groups, often individual entrepreneurs or small investors backed by private capital. A lot of the time it's their own capital, and a lot of the time they're using SBA financing to give you the money for the business. So the pro, they're hands-on, they want to own and operate the business directly. They literally want to become an essential service business operator. They're highly, highly motivated. They're going to care deeply about your legacy. But the con is limited capital, requires complicated seller financing and earnout where you're really not guaranteed that you're actually getting paid the money that they just contractually told you they're going to pay you. And they do have typically very strong SBA covenants, which are different rules that they have to follow to actually qualify for the SBA financing. So you don't want to underestimate. We've seen amazing partnerships from this category, but it is a lower probability of close. So once you actually get through the entire sale process, and we've done other videos talking about that, if you are selling your business to a private equity, either platform or as an add-on, we would say that you typically are in the range of 90% close rate. If it's an add-on, typically it's closer to 95% close rate. With search funds and independent sponsors, we would put that at a 50% close rate. This is once we've actually want to run a process, once we've actually gotten under LOI, we still put that at a 50% close rate. We see lots and lots of these deals fall apart. And these are typically the buyers that business brokers are selling businesses to because they don't understand how complicated it is to do a deal with one of the private equity-backed aggregators. So what buyers actually value? So regardless of the buyer type, every serious buyer is looking for three things. One, predictability, recurring revenue, strong retention, low churn. Two, transferability. Can the business run without the founder? Three, scalability. Room to grow margins, add service lines, and expand geographically. So if we can demonstrate those three things and put those in the CIM, the confidential information memorandum, we're going to get all three types of buyers, and we're going to get a premium offer. So the role of a banker, our job is not to find you one buyer. Our job is to create a market for the business. At the advisory, we run a true competitive process, bringing dozens and dozens of qualified buyers to the table, and we make them compete for your business. We truly make them compete head to head for your business, not just on price, but on structure, terms, and cultural fit. Because for you, you don't just need a buyer, you need the right buyer. If you're thinking about selling your business in the next 12 to 24 months, let's start a conversation. Let's start by talking about your business, what you value, where you currently are, what needs to be fixed to get you the best price in market, and we let you be in control. If you want to sell now, we'll run a process. If you want to sell in 6 months, if you want to sell in 12 months, we are here. We're not going anywhere. When you're prepared, when you're in control, buyers will compete, and you ultimately win. At the advisory, we represent founders exclusively. We are only sell side. We do not represent the private equity firms. We help Main Street achieve Wall Street level outcomes with the right buyers, the right terms, and the right strategy specific for you. It's not about luck. It's about knowing who's on the other side of the table. Again, I'm Oliver Bogner, managing partner of the Advisory Investment Bank. Hopefully these videos are helpful and informative and telling you and educating you about the market. It's something I'm really, really passionate about, and we're looking forward to getting to know you. Feel free to reach out to have a conversation.